Our feature story in the February issue of Compass is all about Argentina, a country of remarkable geographic advantage. Its oil and natural gas deposits and the vast fertile Pampas lowlands make Argentina one of the most resource-rich countries in South America, if not the world. Possessing such ample resources creates equally ample export potential. But all too often, Buenos Aires stands in the way of its own success. This was seen most recently during the administration of former President Cristina Fernández de Kirchner, who kept consumer prices excessively low to gain political favor with the lower middle classes and prevent inflation from going even higher than it was. It also printed currency to cover spending costs and expropriated some assets, which discouraged foreign investment. Now, new President Mauricio Macri has begun to end these policies and implement new ones to halt the Argentine economy's decline, including removing export taxes and quotas on one of the country's main products, agricultural goods. As a result, agricultural exports surged in the first few weeks of his presidency, with soybean, corn, and wheat sales totaling roughly $4 billion by the middle of January. It re-entered the Egyptian wheat market and may soon enter other markets as well. But still, the economy has a long way to go to recovery. Even if Argentina were to fully exploit stored stocks, which would bring in much-needed foreign currency, it would only partially undo the economic damage the country has suffered. Moreover, the global cereal market is already oversupplied. As demand growth remained weak in 2015, the global food price index similarly fell, and is not expected to rise much in 2016. Low oil prices, high inventory levels in China, and a strong US dollar will offset the benefits of price increases. And so while Macri's actions are a good first step, they are little more than that, first steps. We'll also be looking at oil acquisitions. More than a year after the drop in oil prices rattled international markets in mid-2014, low energy prices are looking less like a glitch and more like a long-term trend. That's bad news for some energy firms that have struggled to absorb the shock, but it could be a boon for other companies looking to buy up their weaker rivals. It might also be particularly beneficial for countries looking to gain political edge by investing in overseas acquisitions, especially since so many could not do so in 2015. Now, with the market beginning to correct itself and consensus growing about the direction of oil prices, the returning calm may renew efforts in the energy sector to scale up. Crippled by sustained low oil prices, less resilient companies will be at risk of being swallowed up by firms big enough to withstand the profit losses. And while in all likelihood it will be Western oil companies and private equity firms that stand to benefit the most, some countries in Asia and parts of the Middle East will also join in the buying spree, hoping to not only fuel their growing economies, but also to expand their influence abroad. India and China will lead the way, joined by smaller neighbors in Southeast Asia and by Egypt. For these and other stories, check out our February issue of Compass.